Hi, this is Harsha Venkatesh from Dwaith Funds. I recently wrote a newsletter about CapEx cycles in June of 2026. I'll talk a little bit about newsletter here. One of the most fundamental business truths is cyclicality. So a business is always not one way up. There's always ups and then downs, and then you have an up. Mark Twain used to say this, that history does not repeat, but it does rhyme. Usually when CapEx is done by companies, a year, 2 years later, there is an uptick in sales if the company is in a field which is growing. So that is the business truth as well. We've seen that time and again, and that pattern repeats again and again and again. So you may ask, why am I talking about capital expenditure or CapEx? A lot of changes in the world has been seen now, especially in lieu of the fact that US and Israel have a full-blown war out there with Iran, where they are saying we have a peace treaty almost finalized, but then again it is not very clear, because they say these are the caveats. If Iran attacks, we will attack. If they do this, we will do this. It's not very clear. So there is uncertainty. And apart from that, you also have the ongoing war with Ukraine and Russia. So the war with Russia and Ukraine started in 2022. Mind you, it's been more than a few years now. And we don't know when it is stopping. But in spite of all of this, companies like SpaceX, OpenAI, Anthropic, they are getting valued at trillions of dollars. And with the SpaceX IPO, which came in now, we also have our first trillionaire in the world. Musk is over $1 trillion of net worth. So there are positives as well. But as prudent investors, should we go after AI type companies, which could be potentially a lot of money making over the next few years? But how do we identify those companies which are not trading at valuations which are in the space, but which are more grounded? One of the themes which I have is the aspect of CapEx. What is CapEx? So you may ask, what is CapEx? See, capital expenditure is nothing but where you're making improvements or making investments within your company for machinery, for setting up new plants, warehouses, so on and so forth, wherein you can increase your business. That is the simple way to put this. If I have to provide an analogy of, let's say a 15-year-old who is having a lemonade stand. Let's say he's putting a lemonade stand where he has bought some lemons, where he has a juice squeezer, and then he has a jug, a stirrer. Let's say he's putting some sugar in it. If he only has one jug, one squeezer, one stirrer, his capacity to make lemonades is limited to one jug at a time. Now let's say he wants to expand. So he buys another jug, another stirrer, another squeezer, more lemons, and then he also employs one more of his friend, and he says, why don't you come with me? Let us expand the business. So his investments in buying the new squeezer, the new stirrer, the new jug, all of these are basically capital expenditure. It is expenses towards increasing the capacity of this particular lemonade stand. He can do the funding in basically three ways. One is internal accruals. What is internal accruals? If he is sold lemonade, the profits through which, if he is expanding through the profits, that becomes internal accruals. Second one would be debt. He goes and he asks his parents, let's say, or his friends for a loan. That becomes debt which he is taking on his books to increase his capacity. The third one is equity dilution. So if he is now asked his friend to become his partner, let's say his friend brings in the money through which they buy the jug, they buy the squeezer, they buy other equipment, that becomes equity dilution. Then he will have to share the profits with his friend. So these are the three ways with which he can basically do capital expenditure. That is typically the way a standard company would also do a capital expenditure. Either it is through their own profits which they have accrued over a period of time, or through additional debt or additional equity funding. Now when you are looking at why would a company do capital expenditure? If I am already running a business, why should I additionally put in capital and expand the business? You will do capital expenses if you see more business coming your way. That is a primary reason why someone would want to do capital expenditure. So if you are seeing a capability for the business to sell not just X, but probably 2x or 3x in 2 years, 3 years time. So you are going to put in the expenditure now to do everything for expansion. So that is the main reason why a company would do capital expenditure. So typically, why would it take 2 or 3 years? Because if you are putting a factory, let's say you put in money to create a new factory, buy the land or rent the land, put up the factory and then put up machinery and start manufacturing. It typically takes 2 to 3 years to reach the full capacity. Nobody will be able to fill the factory immediately. So with that being the case, you usually have the 2 to 3 year period when the company would be seeing a increased sales. I want to give you some examples here in this regard, how a company can benefit when it does capital expenditure, especially in a scenario like this where the US dollar has heavily depreciated. It's depreciated more than 10% in the past 1.5 years. What used to be 83, 84, 85 rupees per US dollar is suddenly 95 rupees or so per US. I have a company which I had invested in a few years back, 2 to 3 years back, both for a lot of our clients as well as our own internal investments were also made into this company called Fredun Pharmaceuticals. I will give this company as an example. During COVID is when I first started looking at Fredun because it was heavily depressed and I felt that there is a lot of potential for the products which this particular company was doing. They were mainly in dermaceuticals and nutraceuticals. Now they have also branched out to pet healthcare. So they were selling a lot in India and outside of India. So I felt that this company, right after COVID, they had plans of expansion, and I felt that the founder of the company had passed on the baton to his son by the name Fredun Medora, incidentally the name of the company as well. I felt that Fredun was doing the right things. Right after COVID 21 to 23, he started expanding by all the means. He started doing equity dilution. He also took on debt. And he had also done certain amount of conversion as well, debt conversion also. So with all of these, I felt that there definitely is a play for Fredun in the global market. So I felt that it's a good investment from our side to buy Fredun at either low teen PE or even, sometime we even bought it at sub 10 PE. So I felt that it was a very good entry point. The operating margins since the time we invested has grown from right around 10%. Now I think it's gone beyond 15%, and the revenue has also grown considerably. It's been growing at a rate of 30% year on year. So where do we stand now? Now that the CapEx which has done around 2, 3, 4 years back, it started, delivering results. So the revenue have grown, and since then the operating margins have also expanded. So the stock price has moved up from where we bought roughly 3 to 4 times for most of our clients and for internal investments as well. So where in India are we today on the CapEx cycle? I believe there are 3 clear signals. One is balance sheet repair is mostly done post-COVID. Number 2, government-led CapEx is coming in multiple sectors, defense, railways, infrastructure, so on and so forth. And then capacity utilization across the field, I believe, are rising. So right after COVID, I saw that the capacity utilization was 50%. Sometimes it used to be even below 50%. Now, if you see any good company, the capacity utilization is 75% or even more, which is pretty good. So with this, I believe there is a multi-year earnings growth potential which will open up for certain companies which have done CapEx, and it will also drive operating leverage. What is operating leverage? Operating leverage is as you increase revenue, your profit margin will expand. If your operating margin used to be 15%, 20%, after you increase your revenue, that may go up to 20%, 25%. So you will have some kick in there. And the third one is valuation multiples usually improves once the profit growth as well as revenue growth start coming in. Which are the sectors where we are seeing the CapEx which will get impacted in future? Pharma, chemicals, some engineering companies, some industrial companies. power sector, power equipment makers, infrastructure companies, some metal companies as well. Some of these companies are where we are seeing the CapEx kick in. And what are the risks here? Is it all hunky-dory? Nothing is hunky-dory. There is always a risk factor associated. Let's say there is premature tightening of credit. See, credit is super important. Liquidity and credit are super important for any company to do well in the market. If there is tightening because of whatever reasons, geopolitics, global events, so on and so forth, then there is a problem. If that does not happen, if liquidity is present in the market, if credit uptick continues to happen, what I think will happen is earnings visibility will start improving. Number two, balance sheets will continue to become more strong, and then further investments will also continue to happen. So with this, I believe we are on the verge of seeing a good capital uptick. So the CapEx cycle uptick is something which we will see in the next year or so. So with this, friends, I would like to stop here and say that India is on the verge of a earnings uptick. Thank you.